Hi guys, welcome back to the channel. My name is Dave, and today I want to take a look at JEPY, which comes to us from Defiance ETFs, which is an appropriate name because they're obviously poking the bear over there at JP Morgan with the Y and the I. At least I think so. What do you think? Now I want to take a look at JEPY along with QQQY, two brand new offerings from this company, Defiance, and see if we can use them in our portfolio. After all, after their first distribution, they're offering about a 60% annualized yield. Is that real? Probably not. Let's take a look and find out. If that is what you're looking for, please stick around. Whoop. So both JEPY and QQQY are brand new to the market, less than 1 month old. The only difference is going to be one is about the S&P 500 index options, and the other one's going to be about NASDAQ index options. But brand new, so we don't have that much information. We're still gathering, trying to determine, is this good for our portfolio? So we take a look here, we see an expense ratio of 0.99%. So let's just call that 1%, which is fairly steep, but they are doing daily options, so quite a bit to manage. Now these are really tiny funds at the moment, again, just brand new as they were just introduced. Only about 20 million in JEPY and 56 million in QQQY. Now, they do pay distributions every month, which I know people love, and their first distributions equate to an annual rate of 55% for JEPY and 67% for QQQY.
You serious, Clark?
Should you expect this to be the total return for these two funds? Absolutely not. I would say this is a big blinking sign on the Vegas Strip that says, loosest slots, come on in, buy our fund. So now what is the makeup of these two funds? Well, the base is simply good old T-bills. Similar to HEGH, a fund that I reviewed recently, these have a base layer of income that is currently around 5.5% from using investor dollars to buy T-bills, right? That gives us a great base, a great start. And on top of that, they're going to layer an option strategy. So with HEGH, and I'll link that video above in case you like this idea, you might like that one as well. They're selling conservative credit spreads to try to capture an additional 2 to 4% annually with their option strategy. Now with these two, right, they're selling 0 day till expiration in the money put options against their respective indexes. So this way they're trying to really crank up the return, and of course the risk comes along with it as well. Now the setup is pretty simple. Prior to close of the trading day, they sell their put options, and the next day they manage that option position. Since they are index options, they are European style and settled in cash. I know it sounds kinky. So no real risk of assignment here. You don't have to worry about assignment. But picture a room in the Chicago Board Options Exchange filled with guys that look like they're right out of Sprockets. Remember the old SNL skit? So I'm a little bit older. I'm not really into that Euro style anymore. I'm more into like Oscar style. How's that? So anyway, you will have overnight exposure since they open the position at the close, right? So let's picture Thursday night, they open that position. It'll be like owning the stock, except for the limited upside picked by the put strike. So we'll talk more about this, but similar, same thing as when you sell a covered call on an equity you own. So with these funds, they are using ZERO DTE options, which is akin to gambling. We're getting more and more like gambling. Now, it doesn't mean you're not going to have success with this fund or with that type of strategy, but again, we're looking at a sign that says 60% yield. Come on into the casino. Then inside, we got ZERO DTE options, quick gratification, right? Every single day. We're being conditioned Pavlovian style, just like you're in a slot machine where every now and then they give you rewards so you're stuck there playing. So probably not great for everyone, and I'll get more into ZERO DTE options with some of my content, kind of show you how I use some of them. But just a word of warning, probably not for every individual investor. So what could go wrong? How does this fund make money using 0 day till expiration in the money put options and distribute 60%? Well, it can based on the strategy, but it could also fail. So let's use imaginary stock XYZ to keep the explanation simple and act as our index option, which is always trading conveniently at $100 per share. So we decide to sell in the money puts so that we can capture some of the upside in the index. We pick a $102 strike price, and for writing or selling that option, let's assume we receive a premium of $220, right? $200 of that would be brick and mortar intrinsic value. That is built-in value in the option, since we are on the hook at 102 and the stock is 100. The remaining $20 is time value till expiration, and that is ours to keep essentially, right? So let's suppose the stock trades sideways till expiration. We would have to settle this European style option and pay $200 at the end of the day. So overall, we keep the time value of $20. If we do this all year long over 50 weeks and 5 trading days per week, we would make $5,000, which would give us about a 50% return. Not too shabby. But what if we have a bad day where the stock collapses 5% down to $95 per share? A really bad day. Well, in this scenario, we still make our $20 in the sense that we collect the time value on the option till expiration. But overall, we have to settle that option for $700, which gives us a loss on the day of $480 after adjusting for the initial premium that we collected up front. Obviously not a great outcome. Now, this would represent a significant event, right? The S&P would rarely move that much, but I think this illustrates what could hurt this fund at times. And that is how we limit the upside with the in-the-money put the same way we do with an out-of-the-money call option. So let's suppose the stock goes up 5%, up to 105. The option will be worthless at expiration, so our price to settle the position is $0, which means we keep all $220. That is a great day for us, but since the put strike price of 102 limited our upside, we lost out on the full potential gain up to $105 per share. Now, if we think of all 3 of these trades together as a 3-day period, we're going to see that we collected $20 in extrinsic value each day and are on pace for a 50% return based on that extrinsic value portion of the option. Overall, though, we are down $240 in this specific scenario, which is admittedly extreme and unexpected volatility, right? We're not expecting this. That big loss on day 2 and that gain on day 3 will rarely occur, but that strike selection is an important factor, right? In both how much extrinsic value we collect daily and how much we limit our gain on strong positive moves. And we saw exactly that on Friday when the S&P gained about 1.2% up to around 43.08, but JEPY had sold puts at 42.75. Still a great day for the fund, but limited by the put strike price. So this is a potential risk. However, I would expect the fund to have plenty of muted days, it's called muted days, where the index moves a limited amount in one direction or the other, and the fund is able to add premiums that offset while building up that pile of 20s from all that time premium. So can these funds generate 60% returns and distribute that and maintain their price? Certainly in a perfect world they could, but it's not always going to be perfect. As we saw on Friday, there's unexpected moves that will occur. We're going to limit our upside, and sometimes we're going to have those really bad days that are going to drag the fund down. So don't count on 60%. My goodness, don't do that. But it doesn't mean it won't have a nice return for you overall. So I'm going to continue to watch this one and see how it performs for a while and see how they're managing these options. It is a managed ETF. They are making decisions on these options. They can close out early. I don't know exactly their strategy when it comes to that. But yeah, I'll keep my eye on it because I'm curious. And I'm going to do a follow-up video about the JEPD fund, which is a poke to JP Morgan.
I make you laugh? I'm here to fucking amuse you? What do you mean funny? Funny how? How am I funny?
I haven't decided if this is the day fund or the double income fund, but I'm going to show you another strategy similar to this that you could use that I just tested out this last week. We'll see how it went. So if you like that kind of idea, 120% coming into my casino, then like and subscribe. So 2 new interesting funds from Defiance ETFs. Put them on your watch list. Take a look. They're brand new. No need to rush in. Any questions about this, ask down below. Like and subscribe if you like this type of content, and we'll see you next time. Take care. Whoop.